Good morning, folks. Today is Wednesday, August 26th, 2020. It's time for another trading opportunity to take a look at it. And I wanted to give you a little bit of research behind this trade as we get into it, give you a little bit of an idea of what we look for research-wise when we're trying to find opportunities, find tells in the marketplace, find things that give us edge or advantages. You know, it's interesting. There's over 14,000 underlying assets trading on the U.S. stock exchanges on a daily basis. And so it really is an exercise in hubris and pride and arrogance when we purchase one individual stock. It doesn't matter how much research we do. Basically, we are implying when we make that purchase that, look, we've looked at these 14,000 underlying assets and we found the best. We found the top shelf opportunity, because otherwise, why would we purposely go out and buy something that was inferior or wasn't the best opportunity available? And that's essentially what we're expressing when we buy an individual stock. And we understand the fallacy in that no matter how much research we do, you just can't pick the needle in the haystack, at least consistently over time, over the long-term window. If you are successful picking individual stocks, it's usually due a lot more to the overall marketplace than it is to any individual education or knowledge that you were expressing at that moment. And we get that, and that's really why we saw the rise of mutual funds in the 1960s and 70s. And this was just an idea of how we could effectively diversify ourselves. You guys know that the concept with mutual funds is actually pretty darn good. You can take your $1,000, you can throw it into that pot, and that mutual fund will go out and buy 50 or maybe even 100 different shares of stock in different companies and spread your money around, diversify your money. Now, as time has gone by, we understand that mutual funds are sort of passé. Really the only people, I would say, I know this is a harsh statement, the only people that are putting money in mutual funds anymore are people that are just uneducated. They are one of the most expensive, fee-heavy investment products that Wall Street has available. They are for just complete retail novice investors. We understand now that with ETFs and indices, there's better ways to go out and diversify our money. And that's what's become the in vogue way of investing your money, whether it is the CEO of Vanguard or someone as ostensible as the great Warren Buffett or Charlie Munger. Almost anybody that has been very, very successful as an investor will tell you, listen, unless you want to be a full-time trader or you're working on Wall Street or have insider information, probably the best thing that you can do is take your life savings and throw it into an index, into something that is basically the whole entire market. And there's all kinds of indices and ETFs that you can throw your money into that track the overall market. The SPY is an ETF that tracks the whole entire S&P 500, QQQs. They track, of course, the NASDAQ. The DIAs, the diamonds, they track the Dow Jones Industrial Average. There's all kinds of indices and ETFs that you can throw your money into. And that was a great way to really diversify out your asset base up until about a year ago. And over the last year, and I will tell you specifically, over the last 4 months, that has become less and less the case. As you guys know, the market has absolutely just charged higher and higher and higher. Pretty much whatever indice you want to take a look at today, it hasn't just recovered from the virus downturn. It is at an all-time high. It is at an absolute all-time high. It seems like every day in the marketplace, we're getting new all-time highs day after day after day at the marketplace. However, I would submit to you that while all of these indices, all of these market barometers are hitting new daily all-time highs, that the overall stock market is actually going down. And you say, well, how can that be? You know, if the S&P 500 is tracking the 500 biggest companies in the stock market and it's hitting new highs every single day, doesn't that mean that the overall market is going up? Well, that was the idea, and that was the intent of these indices, that you could just buy one vehicle and get that directional move in the marketplace. The problem, of course, is that the indices are cap weighted. They are capitalization weighted, meaning there is more emphasis put on a larger company than a smaller company. So if you have a $100 million company versus a $1 billion company, that $1 billion company is going to get 10 times the weighting or the importance inside of that particular index. Well, folks, today, when you look at an index like the S&P 500, there's only 4 companies that move that index. That's Microsoft, that's Amazon, that's Google, and that's Facebook. Those multi-trillion-dollar companies, by and of themselves, are worth more than the vast majority of all other companies inside of that entire index. And so as those 4 or 5 companies out there go, so goes the indices. Now, what does that mean? Well, if we dive a little bit deeper into that, let's take a look at the strongest market that we have right now. And the strongest market that we have, of course, is the NASDAQ. The NASDAQ has absolutely just taken off like a rocket place. And we can see that sort of illustrated here. It's kind of hard to miss what the trend in the marketplace is. That's pretty straightforward. It's pretty obvious. However, as we delve a little deeper into that, something that I find interesting is if we look down here. Now, this is the advanced decline line. So this is taking a look at all of the individual stocks in the marketplace and looking at how many of those are advancers and how many of those are decliners. Now, you would just obviously think when you have a market that's doing something like this, that the advanced decline line would be rising. And that's usually what we would see. As the market rises, your advanced decline line rises. You've got more stocks rising on a daily basis than you have falling. Well, look at what we've got going here today. And in fact, this has actually been going on in the NASDAQ back and all the way into June of this year. We actually have a falling, that's correct, we have a falling advanced decline line. There are actually more stocks declining in the NASDAQ on a daily basis than rising. Well, how can the market be going up and hitting all-time highs when the overall market is going down? That seems like a contradiction in terms. Well, it's because of that fact that we've got basically 4 stocks controlling the movement in the NASDAQ: Facebook, Google, Amazon, and Microsoft. And those stocks are going parabolic. They are going straight up a wall. So that reflects this sort of bifurcation that I've been talking about over the last couple of weeks in this market. We have a bifurcation taking place where markets are hitting new all-time highs. However, as you look internally into the marketplace, it's not as healthy as we would think or as the overall indices would imply. If we take a look at maybe some different indices out there, you can sort of see that take place here. Here's the Dow. Dow sort of has the same kind of thing going on here. You can see that the advanced decline line is actually dropping. Let's take a look at the S&P 500. It's not as pronounced, but you can see that the S&P 500 actually has a declining advanced decline line, as well as this market that is hitting fresh all-time highs. What does that mean for us as a trader? Guys, we're always looking for tells. We're always looking for signs, opportunities that we can take advantage of. This is very indicative of market tops. This is very indicative of the concept or idea that if we're not there right now, if we're not at the market top and due for a pullback, we're really close. Doesn't guarantee it. Never a guarantee in the marketplace, but that's what it implies right there. And so with that, we've got a trade idea for you to take a look at today. Let's go ahead and take a look at that. Let's jump into our account. Let's go ahead and take a look at some of the indices that we look at on a daily basis. This is, of course, is the DIA. This is 30 stocks. You can see sort of the trend going on there, and what we feel like, at least, is the trend. It's pretty straightforward, although it's choppy. The Dow is a little choppy. And again, do you want to be using 30 stocks to give you a barometer of what the overall market is? Maybe not. Maybe not. So we could look at something maybe a little bit more diverse which is the SPY. That's the S&P 500 ETF. Tracks all of those different indicators. And you can see that there's a much more pronounced move there. Much more pronounced in terms of where this market has gone. A little bit choppier as well right in here. But the overall trend, again, very clearly to the upside. And that's pretty clear. The big one, of course, the power move that we've been having is the NASDAQ. That's driven by what we call the monsters of tech. And if you can't identify the directional move there, man, we got problems. That is unbelievable. And guys, I would submit to you that it's unsustainable. It's unsustainable. It's not going to be that way forever. The interesting one that I am really focused on right now is the Russell. The Russell. Now, there is the Russell itself that you can trade, which is the RUT. Problem with the Russell as a trading vehicle, though, is that it's priced at almost $1,600. So your trades are going to be a little more expensive. We can, however, use a proxy to trade the Russell 2000, which is the IWM. Now, what is the Russell? What are these indices? Well, the S&P 500 is the S&P 500. That's 500 companies. That's all of the big, well-known, name brand, blue chip companies that you think of when you think of the stock market. The QQQs, the NASDAQ, those are generally tech companies, high growth companies. The IWM, what is the Russell 2000? Well, those would be small cap stocks. And you can see that there's a pretty big divergence. Yeah, we have had some upward movement. There is no question that the trend, the overall trend of this indices has been to the upside. No question about that. But as we look at it in a closer time frame, you can sort of see that we've not only got sort of this topping effect right here, but we've also not been able to break back above. This is one of the few indices that we have not been able to break back above the all-time highs. And I would submit to you that, again, even with the markets hitting these new all-time highs, that the trend right now that we're in is down. So it's only slightly down, but it is down. And so we're going to take advantage of all of this today, with the markets being at all-time highs, with there being weakness in the advanced decline lines. We're going to take advantage, and we're going to put in a call leg only on IWM. So we're going to go to our trade tab here, and we're going to look at trading opportunities. Now, one of the things that we want to generally do with IWM is we want to stick to the standard option expirations. Those would not be weeklies, they would not be quarterlies, they would be standard expirations. Standard expiration dates are the third Friday of each month. And so because this first standard expiration that's coming up is the 23rd, we're going to go to the second one that's available to us. That is the October 16th expiration date. Okay, and we're going to look at this. This is the 51-day expiration date trade, and we're going to see if we can put in a call leg and then possibly a put leg as well. This is the trade that I had queued up earlier that I've been looking at. I believe that this will probably serve us well. Looking at maybe on this October 16th expiration, 51-day trade, selling the 170 calls and buying back the 173. So this would be a $3 spread here that we are creating on the call side. And then down here on the put side, be a little bit of an unbalanced iron condor. You'll see that here in a minute in the risk graph, because we would be selling the 130 puts and buying back the 127s. If we go ahead and look at that in the risk curve, let's look at it here first, just to get a visual interpretation of what this trade will look like. You can see a couple of the components here. You can see it's about a 72% probability trade, about an 86% probability of making some profit. I like both of those numbers. You can see that it is slightly delta negative. That means that it is skewed to the downside. It is skewed to give us more protection to the downside than the upside. And it is some pretty enticing numbers on this trade. If I were to do 4 contracts of each of those legs, that'd be just under $1,000 on my trade. Just about $972 to be exact. And then the maximum profit on that would be about $228. That, of course, implies that 51 days from today, we're going to finish inside of this cash flow zone, this box, if you will. We're going to finish inside of this green box. So that's the implication. Pretty good spreads, pretty tight spreads on the IWM because it obviously is a highly traded vehicle. We've already traded almost 2 million shares so far today. It's very active, of course, as an indices. Nat price on this is listed at 53 cents. Mid price is 58 cents. I'm going to try to, we're going to start it. We'll start it at the mid price of 58 cents. Again, you can sort of see the numbers there on that trade. About $213 net after my commissions and fees. I'm just going to run this. We're going to get a fill on this, and then we're going to look at what the implied rate of return on this darn thing is, because I think it's going to be pretty darn attractive to us. Shows us that we're a little bit off on the mid price here, so I'm going to right click on that, replace that order, come down maybe a few pennies here, and that's going to give me 205 net on the trade. I'm going to send that once again, come back here to my order tab, and it is showing that it's working. It shows that I'm close on the mid price. I'm trying to get this thing filled at 56 cents. We're showing about a mid price here of 58 cents, 57 cents. So I'm close. Just going to keep working this down 1 penny at a time. Nat price is 52 on it. So we're getting closer to that nat price. It's tough to get an above average, a better than average fill on an index when you're trading it, because it is so liquid. And so a lot of times you are going to get filled at that nat price. But I'm going to try to get a little bit better than that. I'm going to go to 54. That looks like that's my fill price, is 54. So if we just replicate that, I want us to replicate that really quick here and look at some of those numbers. See, it's showing mid price now back up at 58, but I got filled at 54. And that, of course, means that I put up about $1,000 and I made $200. I made a 20% rate of return in 51 days. At least that's the implied rate of return, right, that we would get if this trade went to fruition. So if I take $200 and I divide it by that 51-day window, you can see that that is about, well, that's not right. Let's try this again. The $200 divided by our investment of $1,000. That's going to give us about a 20% rate of return over those 51 days. If we take 365 days and we divide it by 51 days, that's going to give us our compounding period. So let's times that by 20% rate of return. That'll give us an annualized number. And that annualized number is 143% APR. 143% annualized potential rate of return on this trade. That's a pretty darn good trade. So again, guys, your trading activity for today is right here. It is on the IWM. That's what we're trading. We're doing a full Iron Condor. We're using the October 16th expirations. That's a 51-day trade. On the call side down here, we're selling the 170 calls. We're buying back the 173s. On the put side, we are selling the 130s and buying back the 127s. I got a fill price of about 54 cents. And unless we get some massive movement in the marketplace here in the next couple of hours, your fill should be somewhere around that range as well. Nice juicy trade, nice good probabilities on that trade, guys. And hopefully that gives you a little bit of insight into how we find these trading opportunities. All of our other trades, guys, are doing awesome. Everything else is just clicking right along. There's no action needed right now. So have a great trading day. Of course, if you have any questions, you can always email me. I'd love to hear from you guys. It is the email askjim@paradigm.press. Let me know how things are going for you, and we'll talk to you soon.